How can you buy a business with no money down? How are savvy buyers structuring their deals? And very importantly, how can you get the seller to be on board? I'm Malcolm Zoppe, an English qualified solicitor specializing in mergers and acquisitions. And in this video, we'll discuss how I would buy a business with no money down. The contents of this video are going to be based on what my buyer clients do with their deals. We'll go over 5 main strategies and how they work together. Namely, number 1, using target finance. 2nd, debt finance. 3rd, equity finance. 4th, seller finance. And lastly, earnouts. So if I were buying a business and based on what seems to be working for my buyer clients, this is exactly what I would do and how I would structure my deal, assuming here that we're dealing with a difficult seller who wants as much money upfront as possible and as high of a sale price as possible, which unfortunately isn't uncommon. So firstly, as much as possible, I would use the target company's cash in the bank to fund the completion payment. So that's the payment that you must make on completion, which is the day you become the owner of the business. So likely the company is going to have cash in the bank. The seller, if they want to extract that money pre-completion, would likely end up having to pay income or dividend tax on that money. Instead, I would encourage the seller to leave that money in the bank and let us use it to fund the completion payment. For the seller, they would end up paying less in taxes, as low as 14%, because instead of paying dividend or income tax, this will be seen likely as a capital gain on their shares. The second main thing that I would do is use the target company's assets to raise finance against those assets. So I would give the company's assets as security to a traditional lender like a bank and would raise finance against those assets, which is going to complete on the day of completion. So simultaneous to me becoming the owner of the business, the lender takes security over those assets and gives me that money. I would do this to try and bridge any shortfall in the completion payment that the target's cash could not cover. Further, I may also be able to use any surplus that comes with the debt finance to pay my professional advisors, like the solicitors and the accountants. If this is still not enough to cover the completion payment, or if I would like to raise further money, for example, because I have expensive or ambitious projects in mind, then I will look to family, friends, and angel investors to raise, for example, equity finance. Essentially, with equity finance, you're giving equity in return for money. You're giving shares in a company in return for an investment. So ideally, I would give family, friends, and angel investors shares in my SPV, my special purpose vehicle, which is going to be the newly formed limited company that acts as the buyer in the acquisition, so that I have the money immediately, even before completion occurs. Now, the SPV will own the target company, so the investors indirectly own the target company themselves. Then, assuming I've tried my best to lower the completion payment, I will defer as much of the purchase price as possible. This is typically referred to as seller finance because I will owe the seller, so the seller is effectively giving me a loan. Now, before we discuss the last creative finance option, feel free to email me if looking for professional legal advice. With our legal advice calls, there are no charges, no obligations, and no nonsense. Contact me now at info.theupbeing.co.uk. Fantastic. Now let's talk about earnouts. If I'm dealing with a difficult seller who wants a lot more money for their business than I'm prepared to pay, then I would bridge that valuation gap using earnouts. So earnouts are a contractual provision, typically in the share purchase agreement, the SPA, where part of the purchase price only becomes payable if the target company achieves specific financial targets. So if, for example, the company makes enough profit above a certain threshold target. So that's how you buy a business using none of your own money, even when dealing with a difficult seller. If you've got any questions, please do put them in the comments below. I promise I will answer any questions you may have. And if you want to dig deeper into the different types of debt finance that are available to you, make sure to watch this video right here. Thank you for watching.